Hi, this is Linda Heiss from Direct Property, bringing you a business perspective to investment properties. Where are your properties sitting in the boom-bust cycle? Working within the finance and property industry, many clients would ask me whether now is a good time to buy, either for residential owner-occupied property or an investment. Talking to hundreds and hundreds of investors over the years, it is difficult to make a purchase decision based purely on returns, as people do get emotionally involved. Whether an investor or an owner-occupier, we all want the same thing: property well positioned, close to transport, shops, hospitals, universities and schools. It is so much easier to rent out a property that has good infrastructure. There are many factors that initiate boom-bust conditions. Monetary policy is needed to slow down the economy when it is overheated. There are also supply and demand levels to regulate. Socioeconomic factors like unemployment, consumer sentiment, and job security, to name a few. All these factors wrapped up together create movement in the market. Even though property is a long-term investment, if you are living in the property, a boom-bust cycle is not that important, as you will ride through many property cycles and upsize or downsize in the same market. However, if you are an investor, there might be a time when you dispose of your properties. Then boom-bust understanding is critical, because you can lose a lot of money by selling at the wrong time. For many decades, around half a century, property values have hugged very closely to the associated rental trend line. A boom cycle is evident when property values escalate above the rental trend line. So if we use the intrinsic value model, which is a rough calculation of how to track the value of your property against rental return, we calculate 20 times the annual rental income to gauge the value of the property. This is a rough benchmark that represents around 5% rental return. So, $10,000 a year rent would represent $200,000 for the value, $15,000 rent, $300,000 for the value, $20,000 a year rent, $400,000 value, and $25,000 rent, $500,000, $30,000 property value of $600,000. So when property value departs from the rental trend line, a bubble is in the making. And what happens to bubbles? Yes, you expect them to burst. Now, the bust cycle in the USA was confirmed in 2008-2009, when the property market fell back to the trend line during the GFC. It is interesting that Australia has not yet responded to this correction. In 2017, there is little downturn. However, there are three outcomes. 1, a burst is yet to happen. 2, there is a slow and gradual downturn to meet the rental trend line. Or 3, a prolonged sideways bounce until rental income catches up to the property value and stabilizes the market again. I guess there could be a fourth one, which would be a new paradigm shift. Of course, if you are buying a property to live in, capital value is not as important. And if you are upsizing or downsizing in the same market, the net amount is similar. So you could sell your home in a boom market and buy in a boom, or sell in a bust and buy in the same bust. You just need to do a few scenario calculations to ensure that you are mitigating your risk. If downsizing, the pros are that you are putting money in your pocket. You can travel the world or just save up for a rainy day, and then owning your home outright. You'll have lower utility bills, a smaller space to maintain, it's cheaper for heating and cooling, and easier to maintain. The cons are for you to be aware of capital gains tax and the uptick in your income the year you sell your house. If upsizing, the pros are that you will be increasing your mortgage with opportunities for future financial gain, if sold in a positive market. This increased value pays off your mortgage when you sell. The cons are that there are plenty of costs involved in buying and moving: stamp duty, legal and property agent fees, higher mortgage, maintenance for a large area. Your end game is to protect your capital no matter what. By understanding the boom-bust cycle, you can better time a property sale and avoid losing money. This is for entertainment and educational purposes only. It is not financial advice. This is Linda Heiss from Direct Property, bringing you a business perspective to investment properties. Remember Rule 1, protect your assets no matter what.